And of course, as we approach compensation season, as we were saying, no better time to talk to Ilana Weinstein. She's, of course, the founder and CEO of the IDW Group, that boutique firm specializing in headhunting and strategically placing talent in the hedge fund and alternative space. She joins us now for her views on the health of the industry, compensation, and basically how the chess pieces are moving around. Ilana, 2019 did seem to be a year of revival for certain of the big, well-known funds. I'm thinking, obviously, Pershing Square up 58.1%. Larry Robinson's Glenview had a great year. Several others had good years. Is this an inflection point or just a good year?
I would almost call it like a last gasp. If you look at, first of all, the market, let's not forget, was up 30% this year. So first you have to look at how much of those great returns were correlated to the market, and then look at the composite of the return for 15, 16, 17, and 18, the 4 years preceding this year. You mentioned Pershing Square. This is the first year in 5 years where he's had a positive return. Greenlight. Still not out of its high water mark. They were down 34% last year. So, the up almost 14% doesn't really help LPs who invested prior to 2019. And so, LPs are hip to this. They're aware of what's going on. They're looking at the composite of, if I invested with you in 2015, how did you do for me? And the reality is, if you look at the aggregate return for 15 through 18, these funds, and this is the majority of the hedge fund industry. There's a whole other category which has done well, but they're few and far between. But the majority of these key man funds, and it's not just long short equity, it's macro too. I know Brevin had a good last 2 years, but the years preceding that were not good. So if I invested with you in 2015, how did you do for me? And the reality is, with the exception for the most part of this year, LPs would not have made money in that time period, from 15 through to 18.
So is that to say that 2020 is going to be a very important year for hedge funds to prove that, yes, they can continue to create alpha even in a market that just refuses to go down?
I do think so, and I think it's a make or break year for many of these funds, because they have to show the same way the trend has been negative prior to this year, they have to show some ability to do one of two things. Either, if they are correlated, really outperform the market, because otherwise they have no business charging 2 and 20, or continue, and this is the category of funds that has done well, continue to generate low volatility, consistent returns that are uncorrelated to the market, and that would be the better multi-managers. And by the way, there are some key man funds, I don't want to, that have done very well. Element is in that category. Rocos is in that category. Tiger Global obviously is in that category. So, but again, we have 11,000 hedge funds, and I could easily go through quickly the ones that are the winners, and most of them are struggling, right?
Well, you bring up Chris Rocos there, and I just wanted to ask you if funds are morphing, if they're becoming more flexible than they were, if they're changing slightly how they do business. He's one example, right? He sort of took back control of all the individual funds and decided that he was going to make the decisions for at least the macro decisions.
Well, Element did that as well.
And Element.
But and I think there's also, so yes, there's structurally some changes that are going on. Also, Alan Howard did something similar.
Exactly.
Right? But the other thing that's interesting, and this goes to the point of how are you delivering value, you have to figure out what you're also best at as a strategy. And if the reality is you're best at, for example, at picking longs, not shorting, then maybe you should be converting to effectively being a long only, like Soroban did. Most of their assets they're investing on the long side. They're not really doing much shorting, and they were up 45% this year. And by the way, that's a winning business model, because if you're just charging on alpha, you still have 15% you can charge that 20% on, and that's attractive to LPs. They feel like they're getting value versus being charged 20% on the full performance, of which a lot is beta.
But how do you make that decision? And I presume you can be involved sometimes yourself in helping them come to these decisions. And that's the hallmark, right, of a successful hedge fund manager, that they're willing to sort of leave their losing bets on the table. But you've seen what you just said with Ackman too, for example. It's pretty much just a long-only fund at this point. When do they decide, okay, short positions don't work for me anymore?
Well, when they look at their AUM, which is just going in the wrong direction, right? I mean, this is survival. This isn't like some sort of strategic epiphany of, I think this is literally, I think I really want to pivot and do X, Y, Z. It's survival, and they have to look at themselves in the mirror and figure out, how am I going to survive? Ackman was 20 billion in 14. He's now 7.5. Greenlight was 12 billion not that long ago. It's now 2 and change. Point State was 10 billion. It's now 5 and change. They haven't had a performance fee in 4 years. Greenlight hasn't had a performance fee in 5 years. So this is all about figuring out, what do I need to do to be successful, and at the end of the day, charging just on the value created that you can't get by buying the market.
How much of those AUM outflows are because of private equity, for example, and direct lending becoming such a huge business now?
I think that the outflows are really performance-based. And this is an interesting thing, which I don't think has gotten enough attention. We've seen hockey stick-like growth, right, for the past, really since I started IDW, since 2003. When I started, I often cite the AUM was 500 billion. It's now around 3.5 trillion. So with the exception of the 2008 crisis, AUM has totally gone up. If you look at net outflows to the industry, so it's both the fact that we are having net outflows and the trend line. This year we had almost $90 billion of net outflows. Why is that important? Well, one, AUM's going in the wrong direction now, and two, we also had net outflows last year, which was 37 billion. So it's more than 2x what it was last year, and more than that, if you look at it's not like we had some like black swan type event like '08, which is what caused these outflows, but rather it's LPs getting really frustrated with performance. We have had the longest stretch of net withdrawals since the financial crisis, and I don't think that's abating anytime soon.
But it's interesting. Where do you see the industry in 5 years or 10 years? Because when a hedge fund goes too big, you mentioned Alan Howard a little while ago, it can have a tendency to then not be effective anymore, to implode, right? But at the same time, unless it has some heft, is there any point to it?
So you bring up a really important question, which is how do you use scale effectively? And the problem is, many of these hedge funds grew up, like AUM, money came in, and then founders didn't do very much with respect to using that capital in a way that would effectively have the hedge fund itself be the thing that makes the investing team better for sitting on it, which is what the better multi-managers like Citadel, Point72, Millennium. By the way, I'd put Schoenfeld is doing great. I mean, they're sort of, they're not quite as big yet, but I stress yet. But if you look at their returns over the last 6 years, again, a very tough time period, it's been 20% annualized. But what these funds are doing, and there's a culture there, and also the better multi-managers, there's a reason GoldenTree and Davidson Kempner are 30 billion and growing. They use scale in a way which is to invest in data, technology, infrastructure, upgrading their team, thinking about what's next. I had to answer your question really directly. I had lunch with the founder of one of those funds on Friday, and he said to me specifically, Ilana, what made me successful? He's thinking like this organically. 5 years ago, it's not what's going to make me successful today. He is automatically thinking about, what do I need to do differently, and investing in the fund versus just sort of, oh, by the way, having 30 billion of AUM and the same team that was there effectively from the beginning and no investment in terms of moving the dial.
We have to talk about compensation, because obviously if you're the key man, you're fine, you're going to be taken care of, and even maybe some of the top management. But if you're sort of on your way up the hedge fund career ladder, is it still a career you want to be really busting your chops in?
Well, let me tell you something interesting. You're not the biggest problem right now facing this industry is you're not. This is like kind of a crazy thing I'm going to say. You're not actually okay if you're sitting at a key man fund that has had depressed performance, and you're a senior person, and more to the point, you've been generating the P&L of the fund. Because the three things that drive compensation in this industry are obviously performance, but then also the size of the fund, right? Less AUM, less management fee, and at the end of the day, less performance fee, because you're working off of a smaller base, and the performance of the individual. And if somebody is a star, and AUM has come down, and the rest of the firm isn't pulling their weight, they have now been through 4 or 5 years, and this year will be no different, of not getting paid. because the founder feels he has to take care of everyone else. And what's happened is we've moved from a pay-for-performance industry to a socialist regime for most of the hedge fund industry. And that's where I come in, and that's where my team comes in, because the
You're going to knock
best
the
people,
socialism out of it?
yeah, I mean, we're going to, well, but talent doesn't want to be part of that. They want to be somewhere. They got into this industry in the first place to be rewarded for what they can produce, and they're fed up. And losing your best people is really what's facing these funds that really can't afford to do that at this juncture.
Ilana, we have to leave it there, but I love it. Thank you. I think that's the first time I've heard socialism and hedge funds used in the same sentence.
It's true.
Thanks to Ilana Weinstein, founder of the IDW Group.